Hello and welcome back to the Dukascopy TV studio. An article in Forbes has stated that tactical asset allocation can improve risk-adjusted returns, the ultimate goal for traders and their advisors. Here today to talk to me about asset allocation is trader Dooley Awadalla. Dooley, thank you very much for joining us today.
Thank you, Natalie.
Now, asset allocation is a strategy that attempts to balance risk and reward. Now, given the current economic environment, this sounds a little bit like financial roulette. Talk me through the tools that advisors use in order to ensure the reward element of this strategy.
Well, the main tool for asset allocation is diversification. They use diversification to mitigate risks. So basically, we diversify across various asset classes, such as equities, bonds, alternative investments, according to the risk profile of a client. And then within each asset class, we further subdivide according to sector and geography.
Critics of this approach have suggested that this strategy is problematic because individual investors require individual solutions. A paper carried out at the Center of Retirement Research at Boston College has stated that the focus on asset allocation is misplaced, presumably because of concentration on investors' age, investment timeframe, etc. What's your response to this?
I tend to agree with that statement. I think the traditional methods of asset allocation, which are more focused on fundamental analysis, are not dynamic enough for today's marketplace. And asset classes are no longer behaving in the way that we expect them to behave, or we were taught that they would behave. So today we see, for example, that equities perhaps no longer provide the best opportunity for long-term growth. Bonds are providing very little yield and are acting almost as volatile as equities. So cash is not providing much return. So I don't believe that the focus on asset allocation is dynamic enough for today's marketplace. There are other approaches which perhaps would be more suitable for functioning and providing alpha, for generating alpha in today's market.
And how do you work around a client's individual requirements, for example, a client's risk appetite?
Well, I think today it's very difficult to mitigate risk in any asset class. Those that we traditionally used to feel were less risky, such as bonds. As I said, today the volatility is extremely high, even within the corporate bond market. So it's difficult to really mitigate risk unless you're out in cash. And even within cash, then we come into the, which currencies are you going to hold it in? How are you going to diversify across currencies? So mitigating risk has become harder, and the search for alpha is also become much harder.
And also a major strategy with asset allocation is using past historic events in order to try and predict future risks and rewards. Given the volatility of the current economic climate, can this still even be relevant?
No, I think a lot of the fundamentals have changed as well, like things that we used to take for granted. Such as, the USA's AAA standing, the various credit standing rating of governments, etc. We can no longer take for granted. So I think it's become very difficult to kind of continue to make the same assumptions based on information from the past, which has changed.
So if we use the principle that different assets behave differently depending on the market and environment, where would you encourage investors to place their investments at the moment?
Today, I think investors really have to focus on trying to generate absolute return while avoiding basically any kinds of correlation to various markets. So we're looking for uncorrelated investments, such as wine, real estate, insurance. There's a lot of things that are totally uncorrelated to markets and interest rates and will generate an absolute return. One of the things that we like a lot at the moment and that we're looking at very closely is the life settlement market, which isn't really, it hasn't really taken off in Europe yet. There is no European market for it. But in the US, life settlements is a growing sector. And I think they have something similar here in Europe with I'm not sure what it's called. It's called Vierge in French. It's when you buy houses from pensioners, for example, and you'll continue to let them live in it, and you maintain the costs of the house. But then upon the demise of the person who's living in the house is then, written over to the fund or to the investor. So there's a lot of things like that which are basically uncorrelated and are based on other things apart from market fundamentals.
Dooley, thank you for joining us in the studio once again. So there you have it, wine, real estate and life settlements. For more interviews with market experts, head over to the Dukascopy TV website. Until next time, goodbye.